Welcome back to Indianomics, and now the promised chat with Kalpana Morparia, the head of South and Southeast Asia at JPMorgan and the doyen of Indian banking, a very seasoned observer, having spent so many years at the helm of ICICI Bank and then afterwards the helm of JPMorgan. Mrs. Morparia, thank you very much for joining me.
Pleasure, Latha, as always.
Let me first start with the bankruptcy code. Do you think that finally we are getting this piece right on banks being able to claim defaulter assets?
India has done a phenomenal journey in terms of increasing the overall ecosystem to a faster possession of collateral. And whether it was the DRTs when they were set up, because that created a separate judicial infrastructure, the SARFAESI Act, and now the new bankruptcy code. And therefore the banks will have a repertoire within their armory, as it were, to deal with recalcitrant borrowers. So, I am indeed optimistic that that will work. In a lot of these cases, it's not just going and possessing the collateral, right? Because these are commercial assets, industrial assets. You want to put them to the swiftest possible use. And therefore, how quickly we can get restructuring done is also, I think, extremely key. And all the efforts currently made by senior banking management in terms of driving that process faster, I think would be really very good. So I'm hopeful. Last point I want to make on this is, if you remember, a lot of the stuck projects and the impaired assets really happened in the infrastructure sector. There has been a significant debottlenecking in the power sector, and I think probably the greatest success story, probably not as much appreciated by us, is what has really been done in the road construction sector. We earlier had Minister Gadkari with us, and he talked to us, he took us through the several remarkable steps that his ministry has really taken to debottleneck this entire thing. And something as simple as saying, if the award is in favor of the company, let's just go ahead and release 75% and not haggle about this. Create an independent body to really assess, because NHAI itself, being a party to the dispute, could not really be both a judge and an affected party. So I think all of this is going to free up a lot of liquidity in this segment and will once again propel this segment forward.
Now to come to the rehabilitation of assets. Yes, the Reserve Bank has gone with this S4A, stressed asset reconstruction, as well as strategic debt reconstruction, looking at changing of a promoter. Not much success. Neither of them have seen much success. It's one complaint or one lacuna which we see is not enough special funds or special situation funds to buy distressed assets like a Wilbur Ross or even O&M companies like Marcel and Alvarez to take over a company that's gone through a bad management. JPMorgan is well placed to see whether these funds will come into India, you think?
I think they will definitely come into India, and I think we are a little too quick to judge that we have not seen success. As you know, this was what, 3 months ago, 4 months ago?
That's true.
These projects take time. I've been in the heart of restructuring some celebrated cases, and sometimes it can take you as long as a year. We all need to collapse the time frame, the difficult negotiations. There are multiple stakeholders involved with this. See, foreign funds are absolutely interested in ensuring that they participate in this overall restructuring of corporate balance sheets. And you've seen some JVs that have been entered into by them, because they feel the expertise of a local banking partner actually makes it that much more attractive. I would urge you to just be a little more patient on this.
Okay, so you feel that in a year or two, we are going to see a lot of these stressed assets rehabilitated?
Absolutely, and I'm not saying it as wishful thinking. We've seen it happen in the past, and I see no reason why we shouldn't.
No, that's why you're here with us, Mrs. Morparia. You've been there, done that, so you're better placed to judge this process. It is action replay, as it were, for you. The other point, very big change that the Reserve Bank is trying to bring about, and you were the first person to identify that this is the reform in the banking space, is that exposures to large indebted companies shall not be more than 20% of Tier 1, or to the whole group 25% of Tier 1, as well not more than 26,000 crores. Incremental debt will be expensive. Will this work? Because it goes down to 10,000 crore as the limit by 2019.
Yes, and as you know, it applies to at a company level, not at a group level. So I think this is a great way for India to really appropriate risks across the spectrum. And if you look at Europe today, there is much more balance sheet that's given out by the banks there, whereas in the US it's just the opposite. So I think this is indeed a seminal move on the part of the banking regulator. We will definitely need much more debt investors, right? Because the supply is going to be great. You're already seeing the benefits of this accrue largely to very well-rated corporates. They are talking about new benchmarks being created every time on the low cost of accessing the domestic capital markets. We are also seeing this phenomenon in the dollar bond market as well, and I'll talk a little bit more about that. So I think it's a great start. The greatest beneficiaries immediately are going to be the high-grade issuers. And the Reserve Bank of India also simultaneously did something else. They allowed banks to credit enhance up to 50% of these exposures. So then you have a really very good mix where you get the benefit of credit enhancement of the banking sector, which understands these risks much better, and you get the liquidity of the debt investors who primarily go by the rating of the instrument that they're going into. So I think this will be another great move. As more pension money comes into the sector, life insurance, general insurance, as you know, all of them, particularly life insurance, is really looking at longer term assets.
But they don't buy below a certain grade. So do you still think the demand piece is addressed?
As I said, the high grade are the greatest beneficiaries, but through some structures you will be able to ratchet up the rating of the underlying instrument. The other interesting phenomenon that's happening now is, earlier a bank would have given debt to a company which had set up a project, and then when the revenue generation starts, they would still kind of hold on to that because there was very little secondary activity. Now what we are seeing is that where you have revenue generating assets, there is an enormous market, both locally and internationally, which will take that out and therefore free up the banks in terms of taking exposure in terms of the new development phase that they're getting into. We've not yet seen the first REIT in India. I hope in the very near future we'll see one. Some of the infrastructure companies are already talking about investment trusts, and that, as you know, creates a perpetual vehicle where you put all completed assets into them.
Coming to the other piece that was unclogged, putting licenses on tap and giving differentiated banking licenses. This comes along with the digital momentum, where, you know, it's not just Jan Dhan, it's the unified payment interface also, which is going to put all our payment activity on our credit profile. Do you think finally the financial sector will finance economic growth much better than the last 3-4 decades, or am I still being too idealist?
No, I genuinely believe so, and the biggest change that's it's going to be a transformational change for India is really digitization. Yesterday we had a very interesting panel. Overseas it would have been called a fintech panel. We said digitization, is it enabler or disruption? It's both actually. It's going to disrupt a lot of traditional models, but it's a huge enabler. And you and I like to talk a lot about the impact of that really to the overall banking system, how does that impact? But if you hear some of the digital players there, they're really talking about the dramatic transformation that this is going to have on the small business, and today the whole set of 350 million people who don't have access to this basic service. So the cost of transferring money, the ease with which small savings take place, is going to be truly revolutionary. And it was a complete eye-opener to me, because I always thought banks have this huge muscle and they can do it best, but the disruption that some of these small players are bringing in through their wallets and their ease of payments, you're actually going to see multiple models, not just working together, but evolving even as they're coming into play.
Okay. Unfortunately out of time, but I have enough fodder from you to believe that primarily on digitization, but also because the legal system is getting put into place, as well as the bank's risks are getting allocated to wider people, India is on the brink of a big banking and financial explosion, which could ultimately abet growth in a big way. Mrs. Motparia, always a pleasure speaking with you.
Thank you.
Thank you very much.
Thank you.